Imagine a world where billionaires play a high-stakes game, profiting from global crises while the average person scrambles to recover. Picture financial giants betting against collapsing economies, failing companies, or even natural disasters, all while sipping champagne in penthouse offices. This is the shadowy realm of hedge funds, where immense wealth is amassed under a veil of secrecy, and the rules seem to bend for those at the top. But what's really going on behind closed doors? Why do hedge funds remain untouchable even as they thrive on chaos? Hedge funds have long captivated the public's imagination, often portrayed as the playground of financial wizards like Ray Dalio or George Soros. Yet beneath the glitz of their astronomical returns lies a troubling reality. These funds often profit by exploiting crises, manipulating markets, and operating in ways that skirt accountability. From betting on economic downturns to leveraging insider knowledge, hedge funds wield power that can destabilize industries and even nations. Let's dive into the mechanisms, strategies, and ethical gray areas that define this secretive industry. Use our code to get the first month free. Profiting from chaos, the Crisis Playbook. Hedge funds thrive in turmoil. While the average investor panics during market crashes, hedge funds see opportunity. Take the 2008 financial crisis. While millions lost homes and savings, funds like John Paulson's Paulson & Co. raked in billions by shorting the subprime mortgage market. Paulson's bet against the housing bubble netted his fund over $15 billion, with him personally pocketing $4 billion in a single year. How did he do it? By meticulously analyzing the cracks in the housing market and betting that mortgage-backed securities would collapse, a move that amplified the crisis's fallout for ordinary Americans. This isn't an isolated case. During the COVID-19 pandemic, certain hedge funds capitalized on market volatility. Funds like Citadel and Renaissance Technologies posted double-digit returns in 2020 by leveraging algorithmic trading to exploit rapid price swings. Meanwhile, small businesses shuttered and unemployment soared. The pattern is clear. Hedge funds don't just survive crises. They engineer their strategies to profit from them. But how do they get away with it? The Secrecy Advantage, operating in the shadows. Hedge funds operate under a shroud of secrecy that gives them a distinct edge. Unlike mutual funds, which are heavily regulated and required to disclose holdings, hedge funds face minimal oversight. Registered as private investment vehicles, they cater to wealthy individuals and institutions, allowing them to bypass many Securities and Exchange Commission (SEC) regulations. This lack of transparency means they can execute complex strategies, such as short selling, leverage, or derivatives trading, without public scrutiny. Consider the infamous case of Archegos Capital Management. In 2021, the fund's collapse sent shockwaves through Wall Street, wiping out $10 billion in market value from major banks like Credit Suisse and Nomura. Archegos used massive leverage, borrowing heavily to amplify bets on stocks like Viacom CBS, without disclosing the full extent of its positions. When those bets soured, the fallout exposed how hedge funds can destabilize markets while operating in the dark. Yet the fund's founder, Bill Hwang, faced no immediate personal financial ruin, leaving banks and investors to bear the losses. This opacity fuels another dark tactic: insider trading. While outright illegal, the line between smart research and insider knowledge is often blurry. In 2012, SAC Capital Advisors paid $1.8 billion in penalties for insider trading violations after multiple employees were found guilty of using non-public information to gain an edge. The fund's founder, Stephen Cohen, emerged unscathed and later launched Point72 Asset Management, proving that even legal consequences rarely dent the untouchable elite. Market manipulation, tilting the playing field. Hedge funds don't just play the markets, they sometimes bend them to their will. One controversial tactic is short and distort, where funds short a company's stock, betting its price will fall, and then spread negative information to drive down the price. In 2023, Hindenburg Research, a hedge fund-like entity, released a scathing report on Adani Enterprises, accusing the Indian conglomerate of fraud. The report triggered a $150 billion drop in Adani's market value, while Hindenburg profited from its short positions. While Hindenburg claimed it was exposing truth, critics argue such tactics prioritize profit over fairness, devastating companies and their stakeholders. Another manipulation tactic involves high-frequency trading, HFT. Funds like Virtue Financial use algorithms to execute thousands of trades per second, exploiting tiny price discrepancies. This gives them an unfair advantage over retail investors, who lack the technology to compete. In 2014, author Michael Lewis exposed this practice in Flash Boys, revealing how HFT firms front-run trades, essentially cutting in line to profit at the expense of others. While regulators have since cracked down, HFT remains a cornerstone of many hedge funds' strategies. The human cost. Who pays the price? Hedge funds' pursuit of profit often leaves a trail of collateral damage. When funds short struggling companies, they can accelerate layoffs, bankruptcies, and economic hardship. Take Sears Holdings, once a retail giant. In the 2010s, hedge funds like ESL Investments, led by Eddie Lampert, acquired significant control, extracting value through financial engineering. By 2018, Sears filed for bankruptcy, laying off tens of thousands of workers. While Lampert's fund profited, employees and communities were left reeling. Sovereign nations aren't immune either. In 1992, George Soros's quantum fund famously broke the Bank of England by shorting the British pound, forcing the UK to devalue its currency. Soros pocketed $1 billion, but the devaluation triggered economic pain for British citizens, including higher inflation and interest rates. These examples highlight a stark truth. Hedge funds' gains often come at the expense of the broader economy. Regulatory loopholes. Why they're untouchable. Why do hedge funds face so little accountability? The answer lies in regulatory loopholes and political influence. Hedge funds lobby heavily to maintain their lightly regulated status. In the US, the Dodd-Frank Act of 2010 aimed to increase oversight, but many provisions were watered down after intense lobbying. Funds also exploit offshore havens like the Cayman Islands to minimize taxes and disclosure requirements. In 2022, the SEC estimated that hedge funds manage over $20 trillion in assets globally, yet much of this wealth remains shielded from public view. Moreover, the revolving door between Wall Street and Washington ensures hedge funds have friends in high places. Former Treasury secretaries like Robert Rubin and Steven Mnuchin have ties to the industry, blurring the line between regulator and regulated. This cozy relationship helps hedge funds evade meaningful reform, cementing their untouchable status. The ethical dilemma: profit over principle? The dark side of hedge funds raises a deeper question. Is it ethical to profit from others' misfortune? Defenders argue that hedge funds provide liquidity, expose market inefficiencies, and drive economic growth. Critics counter that their predatory tactics exacerbate inequality and instability. The truth likely lies in between, but the lack of transparency and accountability tilts the scales toward exploitation. Consider the opioid crisis. While Purdue Pharma faced lawsuits for fueling addiction, some hedge funds invested in the company, profiting from its controversial practices. Similarly, during the 2020 GameStop frenzy, hedge funds like Melvin Capital lost billions betting against the retailer, only to be bailed out by larger funds like Citadel. These incidents fuel public distrust, painting hedge funds as out-of-touch elites who game the system. The untold story continues. The dark side of hedge funds is a tale of greed, power, and secrecy. They profit from crises, manipulate markets, and evade accountability, all while operating in a world most of us will never see. From the ashes of the 2008 crisis to the volatility of the pandemic, hedge funds have proven they can thrive in chaos. But at what cost? The next time you hear about a market crash or corporate collapse, ask yourself, who's really winning? If this expose opened your eyes to the hidden workings of hedge funds, subscribe for more deep dives into the financial world's secrets. Like, share, and comment to join the conversation. Because the more we know, the harder it is for them to hide.